The JSE was firm on Wednesday morning, while its global peers were mixed as investors digest comments by U.S. Federal Reserve Chair Jerome Powell. Today, markets will turn their attention to the U.S. President's State of the Union address, while here at home, the State of the Nation address will take center stage tomorrow. Petri Redelinghuys is the trader and founder of Herenya Capital Advisors. He joins us for the latest market moves. Hello to you, Petri. Give us a sense of how the markets are trading locally, the currency. How are we faring today?
Good afternoon. So it's a bit of a strange time, right? I mean, we saw some US data yesterday as well, and essentially comments from the Fed last night saying, look, strong jobs data means that we are absolutely going to have to continue to increase interest rates. And somehow the US market read that as, okay, so we're going up then, right? So markets are quite strong. S&P last night ended at around 1.3% higher. That's playing into today somewhat with our local top 40 index up around 0.5%. It's off the highs at the moment, but so far a relatively strong day. The rand mostly stable throughout this. It was quite volatile last night with some big swings, but trading currently at 1754-ish. So that's relatively stable. Over the last week or so, well, over the last 3 days, we've seen quite a strong recovery from the oil price as well. That's trading back above sort of $84. So it seems as though the world is still quite strong. I think personally that the market is quite fragile, and that what we're seeing is a bit of a short squeeze, if you will, and that the economic headwinds that we're facing aren't yet out of the way. And particularly if you look at stuff like the US market with a very strong jobs data or print on the jobs data or jobs numbers, that is indicative that interest rates are likely to stay higher for longer and probably continue to rise. I think where the market is focused on is the pace at which the interest rate hikes are taking place. So, for example, 0.5% at increments versus 0.25% increments, which is what they're expecting now, and they're seeing that as a positive. I do feel that the market is kind of playing chicken, if you will, with the Federal Reserve Bank, and odds are they're not. It's the average investor or trader is not going to win, that game. So I think that we continue to be relatively cautious and keeping a healthy cash portion in our portfolios, just so that we can weather some of the storm and ride out some of the volatility without it being too scary or too onerous for the clients invested. Other than that, I think the market is performing relatively well. I mean, if you look at it from a very short-term trading perspective, there are at least some opportunities for those who are active to get involved. For example, Pick and Pay today put out some numbers which the market didn't enjoy too terribly much, and that created some short-term trading opportunities for the guys. The share is down quite significantly on the day. I think it's down around something like about 5% down at the moment, and it's way off the lows as well. So it was quite a bit scarier this morning. And there are other, shorter-term trading opportunities. If you look at the likes of EOH, that's up around 15% today. So I guess it's a market where you really have to take a defensive stance and, pick your battles very, very carefully.
So let's take a look at news from Pick and Pay. They've published their trading update for the 43 weeks ended 25 December 2022. How did they fare?
So what's interesting is that their like-for-like store sales is down somewhat by around 2%. So what's, and some of the other retailers, if you look at them, have done relatively well comparatively. So I think what's interesting is to see, and I know that I'm going to talk about ShopRite now, but it's interesting for me to see that ShopRite's strategy of the 60/60 offering that they have is actually starting to work. They're winning market share from their competitors, and that has led to a disappointing set of results for Pick and Pay, unfortunately. And the market really kind of punishing them on the back of that. So the major thing is that, revenue, if I just quickly have a look at the sort of the highlights here, group sales for the first 10 months were, up sort of for the entire group is up around 10%. But like-for-like sales growth in South African stores is down 2%. So that shows that, the Pick and Pay on the corner is struggling. The group in itself is doing all right, but there is definitely a sense that they're losing a bit of market share to other players in the space, and that the market's not very happy with. The share down 5.25% now. It's trading. It's quite volatile today. So it hasn't gone too well for Pick and Pay, unfortunately.
Well, it's going well for somebody else. Total Energy says the high oil and gas prices bolstered its net profit to a record 360 billion rand in 2022. What are they putting it down to?
Well, I mean, we saw an enormous spike in the price of particularly natural gas as well as oil. And, you know, this is where I think there's a lot of different opinion and maybe a little bit of confusion. What we had, and we had the situation pre-COVID, so there's been almost a perfect storm here for these energy producers, if you will, people like Total, where there is an actual physical shortage in the energy market, particularly for oil and natural gas, right? But particularly for oil. And this shortage existed pre-COVID, and it was driven to a large extent by the ESG narrative, right, where making investments into dirty energy was very frowned upon and not, you know, encouraged. Banks wouldn't finance deals. You know, if it wasn't green energy, they didn't want to be a part of it. And that led to a situation where, you know, there's just not enough oil rigs, right? But luckily, the entire world shut down for basically a year, and energy demand fell off a cliff. So what we saw is energy prices really, really fall very hard, which removed further production from the energy market. And then, as the world started to recover, we saw this energy shortage really starting to bite, and the price of energy and oil in particular and natural gas and those types of things really start to rise. Then you have the situation where so we get very, you know, strong pricing on these, you know, $90 a barrel of oil, that kind of sort of pricing. And then happens the Ukrainian or the Russian invasion of Ukraine. And that creates a lot of fear and shock and tremor through the market. And we see the oil price really spike quite briefly to about $130 or so a barrel. Since then, what we've had is a constrained, particularly LNG or natural gas market, because as we know, Russia is a big supplier to Europe of natural gas. Now, Total Energies obviously does not have money, doesn't have much business in Russia, but they stepped in to, I guess, capitalize on the shortfall of Russian oil, Russian LNG gas that's no longer going into Europe for the most part, and other companies, you know, Shell, Total, all the rest, stand to benefit from this. So we have a number of drivers that have just really, you know, driven the price of these products, of energy really, really high, and those few companies that are able to supply it are able to make the most of that and, you know, scrape in some earnings, which we can only now hope that they would deploy on, you know, some sort of a transformative energy transition type investment. So it's interesting. Total, I'm not so familiar with how their business is structured, but if you look at a company like Shell, for example, Shell, believe it or not, has the largest the largest network of, you know, electronic vehicle charging stations, EV charging stations in Europe, right? So as much as they're an oil business, they're slowly transforming themselves into like an energy producer kind of utility business. And I think that this is probably where the likes of Total would need to go in the next sort of 10 to 15, 20 years if they plan to survive, because at the end of the day, products like LNG and oil will be phased out. LNG might have a longer shelf life than Brent crude oil, but eventually these things will be phased out for green energy. So we can only hope that they're going to use you know, this windfall that they're making now, while energy prices are high, to drive some sort of energy transition or transformative investment over the next sort of 15 years. But in the short term, it does mean that these companies are going to continue to make an enormous amount of money, because the reality is that there is just simply a shortage. There is not enough energy, and demand is ever growing. And we've had a period of artificially low demand because we've all been locked in our houses for a protracted period of time. And yes, even though life for you and me has been mostly back to normal for the last year or so, there are so many jurisdictions in the world where that is not the case, right? Particularly China. And China is starting only now to come out of that really hard lockdown phase, and their economy is only really starting to, you know, go back to normal at the moment. So that means that there's still a huge amount of energy demand that hasn't yet come to market. So, you know, our thinking is that we probably continue to see higher oil prices, and companies like Total will probably have another bumper quarter for, well, probably have another good year or two ahead of them of higher earnings as we see higher energy prices.
Life back to normal, Petri. We could argue about that until the lights come on, because it seems the insurance industry is facing a dilemma that has triggered the introduction of certain clauses that are exclusionary when it comes to people putting in claims after the electricity grid fails. What is happening there, and what does it mean for you and I?
So this is an interesting little development, and it's, I think that it's tough for the consumer. Right? We have zero control over how many times a day, Eskom turns our lights on and off. So, for example, just my personal story last night, power is supposed to come back on at 10. It's on for like 5 minutes. It drops. It takes about 30 minutes. It comes back. It drops again. I mean, it goes on and off maybe 5 or 6 times within the space of an hour before we have a stable, electricity supply again. And that, you can imagine, does an enormous amount of damage to your appliances, right? So because you have this energy surge or this power surge every now and then, your fridge is turning on and off and on and off, as is every other appliance in your house, which is really bad for that appliance. Most appliances, and this is part of the reason so much of Eskom's infrastructure is falling apart, electronics are not really designed to be turned on and off abruptly, multiple times a day. Yes, you can turn them off, but there's generally a shutdown procedure or whatever the case is. Now we're just abruptly turning devices on and off all day. It's not good for them. They take wear and tear and damage from this, which, as you can imagine, leads to a higher amount of claims from insurance products. Now, insurance companies are generally, quite profitable, if you will, provided that they have adequately managed to cover their risk. So they gather premium, they build a big fund against which people can claim, and once the fund is big enough and you have a certain amount of sort of coverage over the risk that you have, you can start to take a bit of the profit off the top. What's starting to happen, though, is that the number of claims for electronic items that are failing due to essentially being turned on and off abruptly multiple times a day, over a pace, if you think about how many years we've been doing this now, right? So if you're doing it to your fridge at the moment and your fridge is like 2 years old, probably not a bad thing. If your fridge is 10 years old, it's definitely going to break. That fridge is likely covered by household insurance. So these devices that are failing because of a circumstance that we as the consumer cannot control is leading to us making higher claims from insurance businesses, and they are getting to a point where they're saying, well, we actually can't afford to pay these claims because we never accounted this as a potential risk. And if we have to, cover these items, we're going to either have to increase the premiums drastically because it's almost guaranteed that we're going to have to be paying out, huge amounts of claims of devices that continue to fail, or we just simply won't cover the risk. And that's essentially where we're at now, where we, the consumer, can no longer get insurance coverage for, electronic devices that are failing because of the grid, which puts us in a bad position. But, the insurance companies are basically just ensuring that they themselves don't go out of business. And it's really a tragedy, for the consumer. So I think the position it puts us in is you, as the household, you have to be aware of what your load shedding schedule is, and you have to take precautions to turn your devices on and off before and after load shedding comes and goes, so that you don't have these abrupt power surges that are a problem. The problem is not so much like if turning the device on, it's that power surge when load shedding ends and you get electricity into your house again. There's a huge spike in power surge, and that, even though it is only very brief, is where the damage takes place. So in order to mitigate this risk, we now have to take responsibility for that and manage the turning on and off of our appliances and our microwaves and fridges and geysers and all that stuff ourselves, because ultimately these devices will fail. And we're now in a situation where your insurance is no longer going to cover it when they do. So I don't really know. It's not a nice thing to hear, but I guess that is the reality of the circumstance in which we are in.
My dear, again, we could argue until the lights come on, because even us, we're subject to wear and tear. How much of this can we take from all angles? But anyway, Petri Redelinghuys, thank you very much for that.